This is David Goldman, Asia Times Deputy Editor, speaking to you from New York City the evening of May 13th. Well, yesterday, Wednesday, the stock market crashed after the U.S. government announced an unexpectedly bad consumer price index number, in fact, the worst since the great financial crisis of a dozen years ago. This morning, the government announced an unexpectedly bad producer price index number, one of the worst in a dozen years, but the stock market rallied. In fact, it recouped the majority of its losses. That seems contradictory, but there is an explanation, and you'll find that in the chart of the day, which shows the stock market's valuation against the size of the Federal Reserve securities portfolio. That is, as the Federal Reserve engages in what it calls quantitative easing, which simply means printing money by buying bonds from the open market, the stock market's gone up. And the one thing investors have learned to do in the past 10 years is do not fight the Federal Reserve. Now, every Federal Reserve official who could be found was wheeled out in one form or another to say inflation is transitory. There's not going to be any Fed reaction. We will continue to maintain an expansive monetary policy. 3 of the Federal Reserve governors and most of the presidents of the regional Federal Reserve banks in the past week have sung the same hymn from the same hymn book. So from the standpoint of investors, there is a dilemma. If you fight the Fed, you miss an opportunity for returns while the Fed is dishing money out. But if you stay too long, to the point where the Federal Reserve admits that it's made a terrible mistake and has to tighten monetary policy, you get crushed. So expect to see the market chop sideways, going back and forth as the investors decide whether to believe the Fed or to believe their own eyes. Now, from our standpoint, the idea that inflation is transitory does not add square with the facts. For one thing, housing prices are up 12% year on year, and the asking price for rent on the median U.S. apartment is up 17% year on year. The rate of inflation for shelter in the consumer price index is between 4 and 5%. So we know the consumer price index, as it's calculated by the economists in Washington, lags real developments in the housing market by 12 to 24 months. So there's a great deal more inflation to come. One of the biggest contributors to Wednesday's jump in the consumer price index was used car prices, up 10%. But we know that wholesale used car prices are up 20% year to date. More to come there. Today's producer price index, which shows an annualized rate of increase of about 7%, portends more consumer price index increases to come. So all of the data, which you can read about in Asia Times, point to higher inflation in the future. It will probably take the Fed to the end of the year to realize that it's painted into a corner. And in the meantime, expect the market to have difficulty making up its mind about what to do this week or next week. We continue to like inflation-friendly issues like energy and financials. We continue to recommend a hedge against rising interest rates, for example, an ETF whose price moves inversely to Treasury prices. And we advise you still to be afraid, be very afraid. This is David Goldman speaking to you from New York City on May 13th.